Tired of losing money and feeling stuck in your trading? This audiobook reveals the powerful mindset shifts that separate successful traders from gamblers. Learn how to control your emotions, manage risk, and develop habits that lead to lasting growth. If you're serious about turning trading into a reliable skill, this is the guide you've been waiting for. Start listening now and change the way you trade forever. Preface. Why mindset matters more than money. Every trader begins their journey believing that success lies in finding the perfect strategy, timing the perfect entry, or uncovering some secret indicator that others have missed. It's a seductive idea that if you just learn enough technical analysis or master a few patterns, you'll unlock the door to consistent profits. But the truth is more uncomfortable and far more powerful. In trading, it's not the tools that determine your success. It's your mindset. Think about it. Two traders can use the same strategy, follow the same rules, and enter the same trades. Yet one ends the month in profit, while the other bleeds capital. What made the difference? Was it luck? Was it market timing? No, it was mindset. The markets are indifferent to your emotions, your dreams, or your bank balance. They reward discipline and punish impulsiveness. They favor patience and destroy those who act on fear or greed. The trader who thrives in this environment is not the one who knows the most, but the one who thinks the best under pressure. This book was born from a simple, profound realization. Mastering your mindset is not just a nice idea. It's the foundation of sustainable success in trading. That if you've ever felt the rush of a winning trade followed by the crash of a reckless loss, you've seen the power of emotion at play. If you've ever hesitated to enter a good setup or added size to a losing position out of frustration, you've experienced how your mindset can make or break your progress. The difference between gambling and growing lies not in the market you trade, but in the mindset you bring to it. You see, most people approach trading like a lottery ticket. They want quick results, instant rewards, and overnight riches. They take unnecessary risks. They overtrade. They tie their self-worth to their account balance. And when losses inevitably come, they fall apart, emotionally, mentally, and sometimes financially. But professional traders think differently. They see the market not as a casino, but as a business. They know that profits come from consistency, not chaos. They detach their emotions from individual trades. They treat risk with respect. And they understand that the real edge is not in some magical formula. It's in the mind. What you're about to read is not a trading strategy book. It's a guide to rewiring your thinking. It's a roadmap for shifting from emotional reactions to logical responses. It's an invitation to stop gambling and start growing, not just as a trader, but as a disciplined decision maker. This book is for those who are tired of chasing trades and ready to build something real. It's for traders who understand that mastering the market begins with mastering themselves. And it's for every person who has ever felt that they are one mindset shift away from finally getting it right. You don't need more information. You need transformation. You need clarity. You need to stop thinking like a gambler and start thinking like a professional. Because in the end, your mindset is the only tool that works in every market, every condition, and every trade. Master it, and everything else will follow. Let's begin. Chapter 1. The truth about trading psychology. Before you ever place a trade, long before you analyze a chart or read a news headline, something far more important is already at play. Your psychology. It's invisible. It's powerful. And for most traders, it's the very thing standing between success and failure. Trading psychology refers to how your emotions, thought patterns, and mental habits influence your decisions in the market. It's the part of trading that no one wants to talk about when they're just starting out, because it feels intangible, almost secondary. Many traders believe that if they can just find the right strategy, success will follow. But the hard truth is this: even the best strategy in the world won't work if your mindset is broken. Your trading results are not only shaped by your analysis, they're shaped by how you respond under pressure, how you handle uncertainty, and how you manage your emotional reactions to wins and losses. Let's break this down. Trading isn't logical. It's psychological. At its core, trading feels like a numbers game. Charts, data, indicators, everything seems rational. But the market doesn't reward rationality alone. It rewards emotional control. Consider this: the moment real money is on the line, your brain stops behaving logically. It starts reacting emotionally. Suddenly, you're not just looking at price action, you're feeling it. A rising price triggers excitement. A falling price triggers fear. A missed opportunity triggers regret. And a loss triggers self-doubt or anger. These emotions, if left unchecked, can take control of your trading decisions. You buy too early because you fear missing out. You hold too long because you hope the market will reverse. You revenge trade to make back a loss. You freeze, unable to act, even when the setup is clear. None of these are rational decisions. They're emotional impulses disguised as logic, and they happen to every trader, regardless of experience, unless they've built the mental discipline to respond differently. The human brain wasn't built for trading. Let's take a step back. Our brains are hardwired for survival, not speculation. In the wild, avoiding danger meant survival. We evolved to recognize threats, react quickly, and seek safety. But in trading, this wiring works against us. When your trade goes against you, your brain sees danger. It panics. The same instinct that told our ancestors to run from a predator now tells you to exit a trade prematurely. Or worse, to hold on to a bad trade because you fear locking in a loss. That we are also wired to seek certainty and avoid discomfort. But markets are inherently uncertain and uncomfortable. There are no guarantees, no outcomes you can control. And that makes your brain scream for relief. To succeed in trading, you have to override these instincts. You must learn to sit calmly in discomfort, to accept risk, to act based on logic, not on fear, hope, or greed. This is what separates the gambler from the professional. Emotional mastery, fear, greed, and the mental battlefield. Two dominant emotions sabotage traders more than any others: fear and greed. Fear can appear in many forms. Fear of missing out, FOMO, fear of losing money, fear of being wrong, fear of pulling the trigger. Each of these can paralyze you or push you into poor decisions. Greed, on the other hand, drives overconfidence. It leads to oversized positions, chasing the market, or holding on to a trade far too long. Greed whispers, just a little more, even when the risk no longer makes sense. Both emotions hijack your decision-making process. They blur your judgment. They cause you to break your own rules. And they always extract a cost. That cost isn't just financial, it's mental. Emotional trading drains you. It breeds anxiety, self-doubt, and burnout. And over time, it turns what should be a profession into a painful cycle of hope and regret. Why most traders lose? It's often said that more than 90% of traders fail. But why? It's not because they're not smart. Many are intelligent, analytical, and hardworking. They fail because they don't master their minds. They keep switching strategies, chasing signals, and jumping from one idea to the next, never realizing that the problem isn't out there. It's inside. The truth is, your mindset is the foundation of your trading success. Without it, no strategy will save you. With it, even a simple approach can become highly profitable. You must become the kind of person who can follow your plan. Stay calm under pressure and treat every trade as just one of thousands, not as a life or death moment. That self-awareness is the first step. So, where do you start? The first step is self-awareness. Begin noticing your thoughts and emotions as you trade. Pay attention to the moments when your heart races or your palms sweat. Observe your reactions after a win or loss. Are you thinking clearly or emotionally? Keep a trading journal, not just for your trades, but for your thoughts. Write down what you were feeling before, during, and after each decision. You'll start to see patterns. You'll see how fear made you hesitate or how excitement made you chase. Once you're aware, you can start to change. You can pause before reacting. You can take a breath before acting on emotion. You can replace fear with rules and replace greed with discipline. This process takes time. It takes intention, but it's the foundation of every successful trading career. Final thoughts: most traders look for answers and indicators and strategies. But the real truth about trading is this: the battlefield is in the mind. Your greatest enemy isn't the market, it's your own impulses. Your greatest weapon isn't a new system, it's emotional control. Your most valuable asset isn't your capital, it's your mindset. When you stop trading from emotion and start trading from discipline, everything changes. Your results improve. Your stress decreases. Your confidence grows. You start to play the long game. And you begin to experience what consistent, sustainable trading actually feels like. Trading psychology is not a side note. It's the main event. understand it, respect it, and master it, and the markets will begin to reward you in ways that no strategy alone ever could. Chapter 2. The Gambling Trap. There's a fine line between trading and gambling. To the untrained eye, they can look almost identical. Charts flashing, prices jumping, emotions surging. But beneath the surface, the difference is everything. One is a skill. The other is a compulsion. One builds wealth. The other destroys it. And if you don't recognize the difference early on, you'll fall into the trap that has swallowed countless aspiring traders. Thinking you're trading, when in reality, you're just gambling. Let's talk about what that really means. The illusion of control. Gamblers believe they can outsmart chance. They believe that with just one more play, one more roll of the dice, everything will turn in their favor. The same mindset infects traders who don't yet understand the game they're playing. They say things like, "I'm due for a win. This setup feels lucky. I'll just double down to recover my loss." These aren't trading thoughts. These are gambling thoughts. And they reveal a dangerous illusion. The belief that you can force a random outcome to bend to your will. The market doesn't care how badly you need to win. It doesn't owe you a reversal. And it certainly won't reward you for being emotionally attached to a trade. The moment you start treating trading like a slot machine, pulling the lever and hoping, you've left the realm of professionalism and entered the gambling trap. How the gambling trap begins. It doesn't start with recklessness. It often starts with excitement. You take a few winning trades. Your confidence grows. Maybe it was luck. Maybe it was a good setup. Either way, you feel unstoppable. So you start pushing harder. Larger position sizes. More trades. Faster decisions. Then, the losses come. But instead of stepping back to reflect, you do what gamblers do. You chase. You take another trade immediately after a loss, trying to make it back. You ignore your plan. You remove your stop loss. You hold and hope. One impulsive trade turns into another. Your account balance becomes a roller coaster. You're no longer following a system. You're reacting emotionally, swinging at the market like it's a game of chance. That's not trading. That's gambling. And the longer you stay in that cycle, the deeper the hole becomes. Gambling behaviors in trading. Let's be very clear. You might think you're trading, but if you're doing the following, you're gambling, overtrading, entering too many trades without a clear setup or reason. Revenge trading, trying to recover a loss by forcing another trade immediately. Ignoring risk, taking oversized positions, or trading without a stop loss. Trading without a plan, making decisions based on gut feelings or emotions. Chasing the market, jumping in late because you're afraid of missing out. Letting losses run, refusing to exit a losing trade, hoping it will turn around. Overconfidence, believing you can't lose, especially after a few wins. These behaviors don't come from logic or skill. They come from emotion, desperation, and a lack of discipline. And they lead to one place: self-destruction. The role of dopamine. Modern trading platforms are designed to be addictive. Every flashing candle, every green or red bar, every order-filled sound. These are dopamine triggers. The same kind of psychological rewards that keep gamblers glued to slot machines are built into trading interfaces. When you win a trade, your brain gives you a dopamine hit. It feels good. You want more. And like any addict, you begin to crave the high of a quick win. But dopamine is a dangerous motivator in trading. It pushes you to trade for the feeling, not the logic. It drives impulsive behavior. It causes you to break your own rules just to get back that rush. Professional traders are aware of this. They remove emotion from the process. They follow routines. They don't chase the dopamine. They chase consistency. That if you're addicted to the thrill, you're not trading for profits. You're trading for pleasure. And that's gambling. The cost of gambling disguised as trading. Let's talk about what's really at stake. The cost of gambling in the markets isn't just financial. That's the obvious part. What hurts more is what it does to your mind, your confidence, your stability. Gambling disguised as trading leads to mental exhaustion, anxiety, and stress, shame, and guilt, damaged self-worth, burnout eventually. Quitting the game altogether. Many traders don't just lose money, they lose trust in themselves. And that's far harder to rebuild than an account balance. The deeper you go into the gambling mindset, the more painful the climb back becomes. That's why recognizing the trap early and stepping out of it is absolutely essential. Shifting from gambler to trader. So how do you stop gambling and start trading? It begins with awareness. Start noticing your patterns. Journal your decisions. Ask yourself before every trade, is this based on a rule or a feeling? If it's the latter, pause. Next comes structure. You need a clear, written trading plan. One that defines entry and exit rules, position sizing, risk tolerance, maximum trades per day, when to stop trading for the day or week. Follow it like a pilot follows a flight checklist. No exceptions. Discipline is what separates the pros from the players. And finally, accountability. Share your goals. Talk to other serious traders. Hire a mentor if needed. Gamblers hide their losses and trade in isolation. Traders track their performance, review their behavior, and grow through feedback. The mindset shift. Real traders understand a simple truth. Trading is not entertainment. It's a business. You don't need to trade every day. You don't need to be in the market all the time. Your job is not to predict. It's to manage risk and execute your edge. Let go of the idea that every trade must be a winner. Let go of the fantasy of getting rich overnight. Let go of the rush. What you want isn't excitement. What you want is freedom. And freedom doesn't come from gambling. It comes from control, structure, and discipline. Final thoughts. If trading feels chaotic, emotional, or addictive, step back. You might be caught in the gambling trap, but the good news is you can step out. You can reset. You can build a different relationship with the markets, one based on clarity, not chaos. Because the truth is, you don't need more trades. You need better decisions, and better decisions begin with a better mindset. This chapter is your wake-up call. The gambler chases. The trader chooses. Which one will you be? Chapter 3. Mindset of a professional trader. There's a defining moment in every trader's journey. A point when you stop chasing profits and start cultivating discipline. A shift when trading stops feeling like a game and begins to feel like a business. That moment is when the mindset of a professional trader begins to take root. While the strategies, tools, and platforms available to amateurs and professionals are often the same, the way they think is entirely different. Their internal world, how they process fear, handle losses, and view success, sets them apart. Let's explore the mental framework that separates professional traders from the masses. Trading is a business, not a bet. Professional traders don't treat trading like a hobby or a high-stakes bet. They approach it like a business, measured, structured, and objective. This means they have a defined process for analysis and execution. They allocate capital with purpose, not emotion. They track performance, review results, and refine. Over time, they don't show up hoping for luck. They show up prepared, knowing that consistent actions lead to consistent results. Amateurs often ask, will this trade win? Professionals ask, is this setup part of my plan? This single shift in thinking, from hope to process, changes everything. Probabilities over predictions. Professional traders understand that they're not in the business of prediction, they're in the business of probability. They know no trade is guaranteed. Winning trades don't prove anything if they came from breaking the rules. Losing trades are not failures if they followed the plan. Trading is a game of edges, small statistical advantages executed repeatedly over time. Professionals accept uncertainty. They know that a single trade is meaningless in isolation. What matters is how well they executed over hundreds of trades. In contrast, amateur traders often obsess over being right. They crave certainty, and when things go against them, they take it personally. Professionals detach. They focus on the process, not the outcome. Emotional detachment. One of the most critical traits of a professional trader is emotional detachment. This doesn't mean they don't feel emotions. It means they don't let emotions drive decisions. They understand that fear, greed, excitement, and frustration are natural, but they must be managed. Here's what emotional control looks like. Not jumping into a trade because of FOMO. Not increasing size out of desperation to recover losses. Not abandoning a strategy after one bad day. Not becoming overconfident after a winning streak. Professional traders treat each trade like a business decision. There is no room for ego. No trade is personal. The market doesn't know who you are, and it doesn't care. Amateurs ride the emotional roller coaster. Professionals stay level-headed, win or lose. Respect for risk. Professionals respect risk deeply. They know that capital preservation is their number one priority. Without capital, they can't trade. Without risk management, they're gambling. With survival, They follow strict risk rules, risking only a small percentage of capital per trade, using stop losses consistently, avoiding overexposure to a single asset or idea, scaling up only when their edge proves itself over time. Amateurs often swing for the fences, risking too much in hopes of a big win. Professionals build their accounts gradually, knowing that slow, steady compounding beats explosive bursts followed by crashes. Risk isn't something they tolerate. It's something they manage with precision. Long-term thinking professionals play the long game. They are not focused on making a quick profit. They're focused on building a consistent, sustainable process that can grow over time. This long-term mindset shows up in several ways. They journal and review trades regularly. They track emotional patterns and refine their mental game. They aim for consistency over intensity. They're not afraid to sit out if the market has no clear setups. Amateurs often chase fast results. Professionals invest in growth. They understand that becoming a successful trader is a journey, not a weekend project. They study, reflect, and evolve. They're not trying to win the market. They're trying to master themselves. Patience and precision. Patience is one of the most underappreciated skills in trading. Professionals wait for their setup. They don't chase. They don't force trades. They act only when conditions align with their system. Here's what patience looks like: sitting on your hands for days without trading, watching price move and not jumping in, passing on marginal setups, even if they end up working. This kind of discipline is what sets them apart. They know that their edge only appears in specific conditions. They don't dilute it by taking impulsive trades, precision over volume, quality over quantity. Professionals understand that waiting is part of trading. A growth-oriented mindset above all. Professional traders are learners. They don't view losses as failures. They view them as feedback. Every mistake is a lesson. Every trade, win or lose, is an opportunity to refine their edge. They ask, what did I do well? What could I improve? Was this trade aligned with my rules? What emotion influenced me today? This mindset of constant self-improvement fuels their progress. They're never satisfied, never stagnant. They evolve with the markets and within themselves. Amateurs often avoid accountability. Professionals seek it. They know that mastery isn't a destination. It's a practice. Confidence built on discipline. Professional traders are confident, but their confidence isn't based on outcomes. It's based on discipline. They trust themselves because they consistently follow their plan. They've built habits, routines, and systems that remove randomness from their behavior. Confidence isn't about feeling good. It's about knowing that, no matter what, you will act with integrity. This inner trust is unshakable. It keeps them steady when others panic. It helps them stay clear-headed during uncertainty. It allows them to stay in the game while others burn out. Confidence built on discipline is the most powerful tool a trader can possess. Final thoughts. The mindset of a professional trader is not something you're born with. It's something you build, day by day, trade by trade. That it's not glamorous. It's not loud. It's quiet, focused, and grounded in self-respect. It says, I trade my plan. I manage my risk. I am not my P&L. I grow through reflection. I play the long game. If you want to trade like a professional, you must start thinking like one. And that begins not with more strategies or more indicators, but with more self-awareness, more discipline, and more patience. Your edge is not in predicting the market. Your edge is in mastering yourself. That's the mindset of a professional trader. Chapter 4. Emotional Discipline. Mastering the self. If you ask any successful trader the secret to longevity in the markets, they will all eventually point to one thing: emotional discipline. Not technical analysis, not market knowledge, not even strategy, because no matter how sound your system is, it will eventually face stress. You will experience drawdowns. Your setups will fail. News will break unexpectedly. The markets will test your patience and your confidence. And in those moments, your emotional discipline, not your strategy, will determine your survival. This chapter is about building the emotional strength to remain calm, focused, and rational. In the most irrational of environments, the financial markets, the inner battlefield. Let's be honest, trading stirs up emotions in ways that few professions do. With every tick of the chart, you're faced with decisions involving uncertainty, risk, and money. That's a powerful cocktail. Here are just a few of the emotions traders face daily: fear of losing money, missing out, or being wrong, greed, the desire to win big, to keep going, to chase more, frustration when the market doesn't go your way, impatience when you're waiting for a setup that doesn't come, euphoria after a winning streak that makes you feel invincible. These emotions are natural, but they're also dangerous because they can hijack your decisions if you let them. Emotional discipline isn't about suppressing your emotions. It's about acknowledging them without obeying them. It's the ability to recognize fear or greed or frustration rising in the moment, and then choosing to follow your plan anyway. It's not the absence of emotion. It's the presence of self-control. Why emotional discipline matters. Markets are unpredictable. You can't control the outcome of any single trade, but you can control how you respond. And over time, that response, your behavior, shapes your results. A trader without emotional discipline overtrades when impatient, doubles down on losing trades, breaks rules after a few wins, abandons plans when results lag, lets one trade affect the next day. Disciplined trader, by contrast, waits patiently for high-probability setups, respects stop losses and risk limits, stays detached from short-term results, makes decisions based on process, not emotion, keeps a long-term perspective through ups and downs. In short, emotional discipline protects you from yourself. And in trading, that's the most important protection there is. Common emotional traps. To master yourself, you must first understand the traps that pull you off track. Here are some of the most common. 1. The FOMO trap, fear of missing out. You see a stock exploding. You weren't in it. Now you feel left behind. So you jump in late just to be part of the move. Result? You often catch the top and ride it down. FOMO makes you abandon logic for emotion. A disciplined trader accepts that missing a trade is better than chasing 1.2. The revenge trap. You just took a loss. Now your ego is bruised. You feel the need to get it back. So you place a new trade, not because it meets your criteria, but because you're angry. Revenge trading is emotional, reactive, and costly. Professionals don't trade from pain. They trade from purpose. Point 3. The euphoria trap. You've been winning. You feel unstoppable. Rules? Who needs rules? You increase your size, take riskier setups, and ride the high, but markets humble the arrogant. Overconfidence leads to recklessness. Discipline keeps your ego in check. Point 4. The hesitation trap. You see a perfect setup, but doubt creeps in. What if it fails? You hesitate. By the time you decide, it's gone. Fear of being wrong causes inaction. Discipline means trusting your plan, not your fears. Training your emotional discipline. Emotional control isn't a gift. It's a skill. And like any skill, it can be trained. Point 1. Develop a pre-trade routine. Prepare yourself mentally before each session. This could include reviewing your rules, visualizing your ideal behavior, taking deep breaths to ground yourself. When you start calm, you stay calm. Point 2. Journal your emotions, not just your trades. Just log entry and exit points. Write down what you felt before, during, and after the trade. Over time, patterns will emerge. You'll begin to see how emotions influence your decisions. Awareness is the first step to control. Point 3. Set emotional rules. Discipline isn't just technical, it's emotional. You can create rules like, if I lose 2 trades in a row, I stop for the day. If I feel emotional, I take a break for 10 minutes. No trading when tired, stressed, or distracted. These rules protect your mindset. Point 4. Embrace boredom. The best traders are often bored because they're waiting. They're not constantly clicking. They're watching, monitoring, evaluating. Emotional discipline often looks like doing nothing. And that's a strength. Building the habit of patience. Patience is a cornerstone of emotional discipline. Most traders lose because they trade too often, not because they trade too little. Train your patience by accepting that not trading is part of trading, practicing mindfulness to stay present and calm, setting clear entry rules and waiting for them, reviewing how waiting led to better outcomes over time. Patience isn't passive. It's powerful, and it's something you can practice daily. Detaching from outcomes. This may be the hardest and most essential discipline of all. Detaching your identity from your results. You are not your last trade. A loss doesn't make you a failure. A win doesn't make you a genius. Professional traders learn to detach emotionally from the outcome of a single trade. Instead, they focus on the process. Did I follow my plan? Did I respect my risk? Did I act with integrity? If yes, then it was a good trade. regardless of whether it won or lost. When you focus on process over outcome, you reduce stress, eliminate regret, and build confidence over time. Final thoughts: trading is a mirror. It reflects who you are under pressure. It shows you your strengths and your weaknesses, but it also gives you the opportunity to grow. Mastering the market begins with mastering yourself. Emotional discipline is not something you flip on like a switch. It's something you build brick by brick with awareness, intention, and practice. Each time you resist the urge to chase, to force, to react emotionally, you become stronger. Each disciplined decision builds your edge. In the end, the traders who survive are not the ones who never feel emotion, they're the ones who respect it, understand it, and rise above it. And that's what mastering the self is truly about. Chapter 5. Process over profits. In the world of trading, chasing profits is a common temptation and one of the most dangerous. Beginners often step into the markets with dollar signs in their eyes, thinking that more money will solve all their problems. But seasoned traders know a deeper truth. Profits are a byproduct of a sound process. In this chapter, we will dismantle the myth that profits are the most important part of trading and replace it with a healthier, more sustainable mindset, one rooted in discipline, consistency, and process. The myth of the profit-focused trader. Many new traders measure their worth and their strategy solely by how much money they make. They obsess over daily gains and losses, tying their emotions and identity to their P&L, profit and loss statements. When they win, they feel euphoric. When they lose, they feel like failures. This roller coaster of emotion creates unstable decision-making and short-term thinking. But here's the truth. Even bad trades can sometimes make money, and good trades can sometimes lose. If your only goal is profit, you may ignore the flaws in your method when you win and overreact when you lose. This creates a loop where your focus drifts further and further away from what truly matters, your process. Process is the blueprint. Imagine a builder constructing a skyscraper without a blueprint. They might get a few floors up, but eventually, things fall apart. Trading without a process is the same. You may stumble into a few lucky wins, but without structure, you're just gambling in disguise. A process is your blueprint. It includes a defined strategy, your edge, risk management rules, how much you're willing to lose, pre-trade routines, your checklist before entering a position, post-trade reviews, your system for learning and improving. This structure doesn't guarantee you'll win every time, but it does ensure that over time, your trading is measurable, repeatable, and improvable. Why the process wins in the long run. The best traders don't think about getting rich quick. They think about mastering execution. They focus on making the best decision possible at each moment, regardless of the outcome. Here's why that works. The law of large numbers. Trading is not about any one trade. It's about hundreds or thousands of trades. A process ensures that your edge plays out over time. Emotional control. A structured process keeps your emotions in check. You're not reacting to outcomes. You're following your system. Consistent behavior. Random decisions lead to random results. Consistent behavior, driven by a reliable process, leads to consistent outcomes. Measurable progress. You can't improve what you don't measure. A process allows you to track performance, identify mistakes, and refine your strategy. The dangers of profit chasing. Let's look at some common consequences of a profit-focused mindset. Overtrading. Taking too many trades to chase gains, often. And poor setups. Revenge trading. Trying to make back losses quickly without considering risk. Breaking rules. Ignoring your plan because you feel this trade will work. Neglecting review. Only caring about wins and losses, not what cost them. All of these behaviors stem from the obsession with short-term profits. They destroy discipline and turn trading into a casino experience. Falling in love with the process. So, how do you shift from chasing money to trusting the process? Here are some powerful mindset shifts. Detach from outcome. Understand that a single trade doesn't define you. Focus on whether you followed your process correctly. Redefine success. Success isn't about profit. It's about flawless execution. Did you follow your rules? Did you manage your risk? That's a win. Embrace the boring. Great trading is not exciting. It's routine, repetitive, and sometimes even dull. Professionals master the mundane. Track your behavior. Keep a trading journal. Not just what you traded, but why you traded it. Were you calm? Did you act on impulse? Over time, you'll start seeing patterns, and that's where growth happens. Process and identity. One of the most powerful aspects of focusing on process is that it begins to reshape your identity. You stop thinking of yourself as a winner or loser based on profits. You begin to identify as a professional, someone committed to mastering their craft. This subtle shift leads to confidence. When the markets are chaotic, you remain grounded because you trust your system. You stop reacting and start executing. Real-world example. The chess grandmaster. Imagine a chess grandmaster. Do they win every game? No. But their success lies in how they consistently make high-quality decisions, one move at a time. They don't panic when they lose a piece or miss an opportunity. They trust their training, their process, and their preparation. That's what makes them elite. Great traders approach the market in the same way. They study their playbook, analyze past games, and prepare before each match. Profits follow, not because they chase them, but because their process is built to produce long-term results. Build your own trading process. If you don't yet have a clearly defined process, start small. Here's a framework to build upon. Define your edge. What type of setups do you trade? Trend following? Breakouts? Mean reversion? Write it down. Risk rules. How much are you willing to lose per trade? Set a percentage of your capital, typically 1 to 2%. Entry and exit plan. When do you enter a trade? When do you exit? Use clear signals to avoid emotional decisions. Routine. What does your pre-market prep look like? Do you journal daily? Plan your routine and stick to it. Review and reflection. At the end of the week, review your trades. Where did you follow your plan? Where did you stray? What will you improve? This process is not rigid, it evolves. As you grow, you'll refine it, strengthen it, and make it your own. But the key is to commit to it. Discipline beats emotion. Process beats impulse. Final thoughts. Profits are seductive. They're loud, flashy, and emotionally addictive. But in trading, the silent work behind the scenes, your process, is what drives real success. Shift your focus. Let go of the need to be right or rich today. Fall in love with the process. Master your routine. Honor your rules. And trust that, over time, the results will come, not through force, but through discipline, patience, and consistency. The traders who succeed are not chasing the money. They're perfecting the process. And in doing so, they allow the profits to chase them. Chapter 6. Risk management is self-respect. In the fast-paced world of trading, risk management is often perceived as a cold, mathematical necessity, a set of technical rules for limiting losses and preserving capital. But for a trader committed to long-term success, risk management is not just a mechanical process. It is a powerful declaration of self-respect that a professional trader does not gamble recklessly or chase unrealistic gains. They protect their capital because they value the work, the discipline, and the mental resilience that went into building it. Managing risk isn't about fear. It's about respect. Respect for your time, your journey, and your emotional stability. Let's break down why risk management is not just a trading tactic, but a mindset. A mindset rooted in personal responsibility, boundaries, and dignity. Point 1. Why most traders ignore risk. The average trader enters the market fueled by emotion, usually greed, excitement, or even desperation. Their goal is not to manage risk, but to make as much money as possible, as quickly as possible. That's the first mistake. Most beginners see risk management as a limitation, a brake on their earning potential. They think, why place a stop loss? What if the market comes back? Why only risk 1%? I could double my money if I just go all in. But this kind of thinking is short-term and rooted in ego. It stems from a lack of clarity about what trading really is, a long game of probabilities and consistency. Risk management feels like a drag because they don't yet understand its deeper purpose. Protection of your psychological capital. Point 2. Capital is not just money. It's energy. Every trade you take affects more than your account balance. It affects your mental and emotional state. A big loss due to poor risk management doesn't just cost you dollars. It costs you confidence. It can trigger fear, revenge trading, self-doubt, and eventually emotional burnout. A professional trader understands that their capital is not just financial. It's emotional, mental, and energetic. Losing control of your trades means losing control of your inner world. The respect you show your trading capital is the same respect you show your future self. Point 3. Setting boundaries is a form of power. Risk management is about boundaries. It's about saying, I will not lose more than this amount. I will not stay in this trade if it moves against me beyond a certain point. I will not risk my emotional health for one trade. These boundaries give you power, not just power over your trades, but power over your own behavior. The market will always be chaotic. It doesn't care about your dreams or your fears. But when you create a structure of risk rules, you no longer react to chaos. You navigate it with intention. Boundaries are not limitations. They are frameworks that protect your consistency. Point 4. Rules that show you respect yourself. Let's look at the most common risk management rules and what they say about you as a trader. The 1% rule. Risk no more than 1% of your capital on any single trade. This isn't just about survival. It's about acknowledging that no trade is worth blowing up your account. Stop-loss placement. Always set a stop-loss. This is not a sign of fear. It's a sign of control. It tells the market, I know where I'm wrong, and I'm willing to accept it. Risk-reward ratio. Only take trades where the potential reward outweighs the risk. This shows that you value your decisions and don't trade based on hope. Daily loss limits. Decide in advance how much you are willing to lose in a day. If that number is hit, you walk away. This prevents tilt, emotional revenge trading, and long-term damage. These rules are not about being perfect. They're about being prepared. Point 5. The ego versus the professional. The ego wants big wins. It wants to be right. It wants to outsmart the market. But the professional wants consistency. They know that risk management is a daily act of humility. It's admitting, I could be wrong. I will be wrong. But I will survive, and I will learn. The ego seeks validation. The professional seeks evolution. Risk management is what separates the reckless from the disciplined. It turns trading from a roller coaster into a sustainable process. Point 6. You don't have to be right. You have to be smart. A common misconception among beginner traders is that they must be right most of the time to make money. But in reality, even a trader who is right only 40% of the time can be profitable if they manage risk properly. This is where self-respect comes in again. If you can consistently cut your losses short and let your winners run, you don't need to chase perfection. You need to trade with integrity to your plan. Being smart in trading doesn't mean outthinking the market. It means outbehaving the average participant. Point 7. The inner freedom that comes with risk control. Ironically, the more rigid you are with your risk rules, the more freedom you gain in your trading. When you know that every trade has a defined risk, you stop fearing the outcome. You can execute with clarity. You're no longer emotionally attached to each position. You're not chasing or hoping. You're operating. This inner freedom is what every professional trader strives for. It's the quiet confidence of someone who knows they're not gambling. They're growing with intention. Point 8. Final thoughts. Respect is a daily practice. Every trade you take is a reflection of who you are. Are you someone who respects your capital, your process, and your long-term vision? Or are you someone driven by impulses, shortcuts, and emotions? Risk management is not a one-time lesson. It's a lifelong practice. It is the daily expression of your trading maturity. When you manage risk with discipline and care, you're telling yourself, I believe in my growth. I respect my time. I protect my future. And that, more than any indicator or strategy, is the true mindset of a successful trader. Key takeaway. Risk management is not a safety net for weak traders. It's the armor of the strong. It is the clearest sign that you're in this game to win, not just today, but for life. By respecting risk, you're ultimately respecting yourself. Chapter 7. The power of patience in a world addicted to speed. Trading rewards those who can wait. Patience is not the absence of action. It is the ability to wait for the right action. In trading, the biggest wins rarely come from rapid decisions or impulsive entries. Instead, they come to those who have the discipline to wait for confirmation, to wait for a setup, to wait for the market to come to them. Patience is the emotional posture of a professional. It's not passive, it's deliberate. It's not lazy, it's strategic. Why patience is a trader's superpower. Every trader enters the market with hopes of making money. But few realize that the path to consistent profits is paved with delayed gratification. The amateur sees an opportunity and pounces. The professional sees the same opportunity and waits for a signal, a confluence, or a confirmation. That gap between seeing and acting is where the real edge lies. Impatience in trading often leads to premature entries, over-trading, revenge trading, and missed exits. The market does not move according to your needs or your schedule. It moves according to its own rhythm. Patience aligns you with that rhythm. It allows you to enter the market when the probability is stacked in your favor, not when you're emotionally triggered. Patience is what keeps you from trading just because you're bored. It's what stops you from forcing trades after a loss. It's what allows you to sit in a winning trade rather than cutting it short because of anxiety. Patience is the mental software that runs underneath every successful trading system. The market rewards the patient, punishes the eager. Think about this. Most of the time, the market is in a state of noise. Trends are rare. Clear setups are even rarer. And yet, traders want to act all the time. Why? Because they're uncomfortable with waiting. But trading is not about being active. It's about being accurate. You wouldn't fish in an empty pond just because you feel like fishing. In the same way, you don't place trades just because you want action. You wait until you see movement in the right direction, with clear water and healthy signs. Then you cast your line. If nothing bites, you wait again. The greatest traders, from Jesse Livermore to Paul Tudor Jones, have all said the same thing in different words. The big money is made in the waiting, not in the buying, not in the selling, but in the waiting. Patience in the three phases of a trade. Let's break it down into three parts. 1. Before the trade, waiting for the right setup. This is where most traders fail. They get tired of waiting for the perfect confluence, so they convince themselves that a half-baked setup is good enough. But trading success doesn't come from good enough. It comes from only acting when the odds are truly in your favor. Have a checklist. Have your strategy. Have your conditions clearly defined. If they're not met, don't act. The market will always give you another chance. But your capital will not survive repeated impatience. Point 2. During the trade, letting profits run. Getting into a trade is easy. Holding it is hard. This is where patience is again tested. Most traders exit too early out of fear. The fear of losing unrealized profits, the fear of the market turning, the fear of missing out on other trades. But a professional knows the power of trailing stops, of scaling out, and of letting winners breathe. You must trust your system. If your edge says the trade has room to run, let it run. Don't rob yourself of the full potential of a winning setup because your emotions are louder than your plan. Point 3. After the trade, not forcing the next one. After a win, you may feel euphoric and want to ride the high. After a loss, you may feel desperate to recover. In both cases, you're vulnerable. The antidote: patience. Wait for your mind to clear. Wait for your next setup. Wait until your emotions settle and your edge reappears. This space between trades is where your professionalism is most visible. Anyone can place a trade. It takes wisdom to hold fire, patience, and time frame alignment. Patience looks different depending on your time frame. A scalper's patience may mean waiting an hour. A swing trader's patience may mean waiting a week. A long-term investor's patience may stretch over months. But the principle is the same. You do not act without alignment. You must also be realistic about your time frame. Don't expect daily candles to move like 5-minute charts. Don't expect long-term trades to pay you overnight. Your expectations must match your time frame. Otherwise, you'll always feel disappointed, no matter how well you're doing. The emotional mechanics of patience. Patience is not just a mental habit. It's an emotional skill. You have to become comfortable with not knowing, not acting, not having. That's hard for most people, but it's essential for traders. You can train patience like a muscle. Here's how. Meditation builds awareness of your emotional impulses and trains the mind to observe without reacting. Journaling helps you spot patterns of impulsive behavior and reframe them. Delayed gratification practice. Outside of trading, practice small acts of waiting. Skip dessert, pause before answering, slow down your decision-making. Backtesting builds confidence in your system so you can trust it enough to wait for setups. When you realize that impatience is costing you more than missed trades, that it's draining your emotional capital, you'll start to see patience not as a delay, but as a strategy. Patience is a sign of strength. Most traders think of patience as weakness, as inaction. But in reality, it takes more strength to wait than to act. The market is always tempting you to move. It lures you with flashing candles, trending news, and emotional triggers. Patience is your shield. It keeps you focused, grounded, and clear. Ask, yourself. Do I want to be right now? Or do I want to be profitable long term? A professional trader is not obsessed with every opportunity. They're obsessed with only the right ones. That filter is called patience. Final thoughts. Let time work for you in the end. Trading is not a sprint. It's a marathon filled with small sprints and long pauses. And in those pauses lies your power. Time is not your enemy. It's your greatest ally, if you allow it to work for you. Patience, when mastered, transforms your entire trading mindset. It keeps you out of bad trades, holds you through good ones, and gives you clarity between the noise. It may be the most underrated trading skill, but it's also the most profitable. That don't just study the charts. Study your emotions. Don't just measure your P&L, measure your patience. Because the trader who can wait wins. Chapter 8. Detachment from money, freeing your mind to trade with clarity and confidence in the high-stakes world of trading. Money is the fuel, but ironically, obsession with it is what burns most traders out. Detachment from money doesn't mean not caring about profits. It means caring more about your process, mental clarity, and long-term performance than about the next dollar made or lost. This chapter will explore why developing emotional neutrality toward money is essential and how it can unlock the focus, consistency, and confidence needed to succeed like a professional. Why traders get emotionally attached to money. Humans are naturally emotional beings. Money, by its very nature, evokes deep psychological responses: fear, greed, pride, shame, even euphoria. In trading, these emotions are amplified because the market constantly puts your decisions to the test. Every trade has the potential to make you feel brilliant or like a failure. But what really drives this emotional roller coaster? Ego identification. Many traders tie their self-worth to their P&L, profit, and loss. A win makes them feel successful. A loss feels like a personal flaw. Survival instincts. Money is associated with safety, status, and freedom. Losing money can feel like a threat to one's very security. Short-term focus. When traders focus on making money now, every tick in price becomes personal. The emotional stakes rise, and so do the chances of error. Without awareness and control, these emotional reactions lead to impulsive behavior, revenge trading, hesitation, or fear-based exits. What detachment really means? Detachment doesn't mean apathy. It means emotional balance. To trade successfully, you must care deeply about executing your plan, but be indifferent to the outcome of any single trade. You must commit to your edge, your strategy, and your discipline without becoming emotionally enslaved by the need to win every time. This mindset frees you from the toxic loop of overtrading after a win, euphoria/gambling mode, hesitating after a loss, fear/freeze mode, forcing trades to get even, revenge mode. Professional traders know that success comes from 1,000 small, consistent actions, not emotional swings. Practical strategies to cultivate detachment. So, how do you achieve this emotional neutrality toward money? It requires conscious mental training. Here are proven practices that build emotional distance without sacrificing motivation. 1. Focus on executing your plan. Not making money. Every trade should be evaluated on whether you followed your process, not whether it made or lost money. Reward yourself mentally for perfect execution, even if the result is a loss. Detach your validation from your outcome. Point 2. Use a fixed risk model. If you risk the same small percentage of your capital on every trade, each outcome feels less dramatic. There's less emotional turbulence when losses are controlled and expected. As part of the game. Point 3. Stop checking P&L. Constantly obsessing over how much you're up or down during the day feeds anxiety. It causes premature exits, missed setups, or reactivity. Set a rule to only check P&L at the end of the session, or, better yet, weekly. Point 4. Journal emotions, not just trades. Record how you felt before, during, and after each trade. Over time, you'll notice emotional patterns that sabotage you. Awareness breaks the cycle. Point 5. Visualize trading from a neutral mind. Visualization isn't just for athletes. Spend 5 minutes each day visualizing yourself placing trades calmly, sticking to your plan, and not reacting emotionally to wins or losses. Detachment builds long-term resilience. Here's the truth. Every trader will lose money. Even the best in the world are wrong 40 to 50% of the time. The difference is that professionals don't let losing affect their identity or decisions. They have psychological resilience, a trait built through detachment. By emotionally detaching from money, you stop overreacting to market randomness. You reduce trading errors caused by stress or greed. You trade with more clarity, patience, and consistency. Over time, this mindset leads to compounding growth, not just in your capital, but in your skill, discipline, and confidence. The paradox of profit. Here's the paradox. The less emotionally attached you are to money, the more you'll make over time. Why? Because your decision-making becomes cleaner. You stop chasing. You stop forcing trades. You only take high-quality setups based on logic and preparation. And that consistency compounds. In contrast, those who chase profits obsessively tend to blow up their accounts. They trade emotionally, break rules, and live in a constant cycle of hope and fear. They may have short-term wins, but they rarely last. Detachment is a skill, not a switch. Detachment doesn't happen overnight. It's a skill, just like reading charts or managing risk. It comes through repetition, awareness, and mental conditioning. You'll still feel emotions when you lose a trade, but you'll stop acting on them. You'll still get excited by a big win, but you'll stay humble and grounded. The goal is not to be a robot. It's to be a disciplined human. And this mental state is what separates the consistent trader from the struggling one. Final thought. Trade to win, but don't need to win. There's power in not needing the next trade to be a winner. When you're detached, every decision comes from strength, not desperation. You enter trades with clear intent, manage them with calm precision, and exit without regret, whether in profit or not. This is the mindset of the elite. So train your mind not to obsess over the scoreboard. Train it to love the game. The money will follow. Chapter 9. Confidence without arrogance. Balancing self-belief with humility for lasting trading success. In trading, confidence is essential. Without it, hesitation can cost you opportunities. Yet, too much confidence, arrogance, can blind you to risks, lead to reckless decisions, and ultimately destroy your account. The difference between these two is subtle but profound. This chapter explores how to develop confidence without arrogance, a balanced self-belief grounded in humility, preparation, and respect for the market. Why confidence matters in trading. Trading is a game of uncertainty. You must make decisions with incomplete information, under pressure, and often with conflicting signals. Confidence allows you to act decisively, trust your analysis, and execute your plan without second-guessing. Without confidence, you hesitate and miss entries. You exit trades too early. You doubt your edge and give up prematurely. You become paralyzed by fear or indecision. Confidence fuels persistence. It keeps you in the game through losses and setbacks. It's the foundation for learning and growth. The danger of arrogance. Arrogance is misplaced confidence, a belief that you are infallible or superior to the market. It often emerges after a streak of wins or from ego-driven trading. Signs of arrogance include ignoring risk management rules, overtrading or increasing position sizes impulsively, dismissing advice, feedback, or new information, underestimating market complexity and randomness, blaming losses on external factors instead of self-reflection. Arrogance breeds complacency. It blinds you to mistakes and inflates your ego, making a painful downfall inevitable. Building healthy confidence. Foundations and practices. Healthy confidence is earned, not assumed. It grows from preparation, experience, and honest self-assessment. Point 1. Master your process. Confidence is a byproduct of a reliable, tested trading process. When you know your edge and follow your plan consistently, you develop trust in yourself. Focus on executing your strategy flawlessly. Celebrate process wins rather than solely financial gains. Point 2. Embrace continuous learning. Confidence grows when you stay curious and humble. Markets evolve, and so must you. Adopt a learner's mindset. Review your trades critically. Seek feedback. Acknowledge what you don't know. Point 3. Practice self-awareness. Monitor your emotions and behaviors. Recognize when confidence turns into overconfidence. Pause before large decisions. Ask yourself if your actions align with your rules and risk tolerance. Point 4. Accept losses as part of the journey. No trader wins every trade. Confidence is not about perfection, it's about resilience. Accept losses gracefully. Analyze them objectively. Use them to improve. Confidence in action. What it looks like. Confident traders enter trades with conviction but remain flexible. Manage risk carefully, never ignoring stop losses. Are patient, waiting for setups that meet their criteria. Take responsibility for their results. Stay calm under pressure. They understand that the market is bigger than any one trade, and they're playing a long game. Humility. Your most powerful ally. Humility is often misunderstood as weakness. In trading, it is strength. Humility means respecting the market's unpredictability, acknowledging your limitations, staying open to new information and perspectives, being willing to admit mistakes. This mindset creates a feedback loop where confidence and humility support each other. Confidence to act, humility to learn and adapt. How to avoid the pitfalls of arrogance. Stick to your rules. Arrogance tempts you to break your plan. Discipline keeps you honest. Limit position sizes. Overconfidence can lead to oversized bets. Manage your risk first. Journal regularly. Writing about your trades and emotions uncovers blind spots. Seek accountability. Discuss trades with peers or mentors who can provide objective feedback. Stay grounded. Remember, markets are unpredictable. No one controls the outcome. Final thoughts. Confidence as a balanced state. True confidence is quiet, steady, and grounded. It is not loud or boastful. It is the calm voice that says, I have prepared. I will do my best. I accept what happens. Next, as you cultivate this balance, your trading decisions become clearer, your discipline stronger, and your results more consistent. Confidence without arrogance is the hallmark of a trader who is not just surviving, but thriving in the markets. Chapter 10. Creating a growth plan, not a get-rich plan. Shifting your focus from instant wealth to sustainable development in the trading world. The dream of getting rich quick is a powerful lure. It draws countless hopeful traders into the markets, with high expectations and little preparation. But the harsh truth is this: trading is not a get-rich-quick scheme. It's a path of continuous growth, discipline, and patience. The traders who succeed long-term are those who focus on building a growth plan, not chasing fast money. This chapter will guide you through creating a growth-oriented mindset and plan, helping you develop the skills, habits, and resilience needed to thrive in the markets over years, not days. The problem with get-rich plans promise rapid wealth through a secret system or a lucky break. They are fueled by exaggerated marketing stories of overnight millionaires, unrealistic expectations about risk and reward. These plans focus on outcomes rather than processes, profits rather than progress. This mindset encourages impulsive trades, excessive risk-taking, and emotional reactions. The result? Most traders lose their money fast, lose confidence, and give up. Why growth is the real goal? Growth is about developing yourself as a trader, your skills, mindset, and consistency. It's about small, incremental improvements that compound over time. Growth plans focus on mastering your trading strategy, enhancing your emotional discipline, strengthening risk management, building effective routines and habits, learning from every trade. Win or lose. A growth plan accepts losses and setbacks as part of learning. It values process over profits, recognizing that profits will follow when the process is sound. The elements of a growth plan. Creating a growth plan means structuring your trading journey around development, not quick wins. Here are key components to include. 1. Set learning goals, not profit targets. Instead of obsessing over monthly earnings, set goals like improving your win rate by 5%, reducing impulsive trades, enhancing your journal discipline, increasing patience. On entries, these goals keep you focused on what you can control, your behavior and decisions. Point 2. Commit to consistent practice. Just like any skill, trading improves with deliberate practice. Dedicate time to study markets daily, review past trades weekly, simulate trades and demo accounts, learn from mentors or courses. Consistency beats intensity. Small daily improvements build expertise over time. Point 3. Develop a feedback loop regularly. Analyze your performance, identify mistakes, and adjust your approach. Use a trading journal to track what went right, what went wrong, emotional states during trades. Lessons learned. This reflective practice transforms failures into growth opportunities. Point 4. Plan for drawdowns. Periods of losses are inevitable. Instead of fearing them, plan for them. Understand how much loss you can tolerate emotionally and financially, and have strategies to manage stress and stay disciplined during tough times. Point 5. Focus on process metrics. Track indicators like number of trades taken according to plan, average risk per trade, time spent preparing, emotional control scores. These metrics tell you more about your development than dollar amounts. Shifting your mindset from instant results to long-term growth. To create a growth plan, you must first shift your mindset. Here are mental pivots to embrace: patience over impatience. Understand that mastery takes time. Avoid the trap of "I need to be rich now." Progress over perfection. Strive for improvement, not flawlessness. Mistakes are learning steps. Humility over arrogance. Accept that you don't know everything and remain open to learning. Process over outcome. Focus on following your plan, not on the money you make each trade. Resilience over avoidance. Prepare to face setbacks without losing heart. This mental framework will keep you steady through the inevitable ups and downs of trading. How to build your personalized growth plan. Here is a step-by-step approach to crafting a growth plan tailored to your goals and experience. Assess your current level. Be honest about your strengths and weaknesses. Review your trade history, journal entries, and emotional responses. Define clear, measurable learning objectives. Set goals such as limit risk to 1% per trade consistently. Journal every trading day without fail. Spend 30 minutes daily studying price action. Create a daily and weekly routine. Structure your day with dedicated time for preparation, trading, review, and education. Build accountability. Systems. Share your goals with a mentor, join trading groups, or use apps to track progress. Review and adjust regularly, monthly or quarterly. Revisit your plan. Celebrate progress and refine areas that need work. The long-term rewards of a growth plan. Adopting a growth plan transforms your relationship with trading. It leads to increased confidence grounded in skill, not luck. Reduced stress and emotional reactivity. Consistent performance through disciplined habits. A sustainable career. Rather than burnout or frustration, deep satisfaction and mastery and progress beyond money. Final thought. Build your trading legacy. Trading is more than making money. It's about building a craft, a skill, and a mindset that serve you for life. Your growth plan is your blueprint to that future. It's the antidote to fleeting luck and reckless gambling. It is the steady, patient work that creates real, lasting success. Resist the temptation of shortcuts. Commit to growth. Over time, your efforts will compound, transforming you from a hopeful beginner into a confident, disciplined, and profitable trader. Chapter 11. Habits that build the right trading mindset. Daily practices to cultivate discipline, focus, and resilient. Success in trading is not a product of luck or occasional brilliance. It's the result of consistent habits that reinforce the right mindset, habits that build discipline, sharpen focus, and strengthen emotional resilience. In this chapter, we'll explore the essential habits every trader must cultivate to maintain a strong, professional mindset day after day. Why habits matter in trading. The markets can be unpredictable and stressful. Without structured habits, emotions like fear, greed, and impatience quickly take over. Habits serve as your foundation. They automate good behavior and minimize impulsive mistakes. That well-crafted habits also create momentum. Small positive actions repeated daily lead to significant improvements over time. They form the backbone of your growth plan and ensure that your mindset stays aligned with your goals. Key habits that support the right trading mindset. 1. Pre-trading preparation. Start your trading day with a clear, focused mind and a solid plan. Preparation includes reviewing market conditions, analyze global news, economic calendars, and overnight price action. Checking your watch list. Identify potential setups and prioritize trades that meet your criteria. Setting daily intentions. Define what you want to focus on today. Discipline, patience, risk management. Mental grounding. Take a moment for breathing exercises, meditation, or visualization to calm nerves. Preparation builds confidence and reduces reactive decisions. Point 2. Maintaining a trading journal. A detailed journal is one of the most powerful tools for growth. Record not only your trades, but also your thought processes, emotions, and reflections. Include entry and exit reasons, trade outcome, and statistics, emotional state before, during, and after the trade, lessons learned, and improvements for next time. Regular journaling promotes self-awareness, accountability, and continuous learning. Point 3. Following a routine creates structure in a market full of chaos. Design a daily and weekly routine that includes market analysis, time trade planning and review sessions, education, and skill-building activities. Rest and recovery periods. Stick to your routine consistently. It trains your brain to expect and perform productive behaviors automatically. Point 4. Risk management discipline. Make managing risk a non-negotiable habit. Before every trade, confirm your risk per trade is within your limit. Set stop-loss orders. Determine position size based on risk tolerance. Habitual risk management protects your capital and preserves your mental energy. Point 5. Emotional check-ins. Trading triggers strong emotions. Develop the habit of regular self-assessment. Pause during the trading day to check your emotional state. Recognize signs of stress, overconfidence, or frustration. Take breaks when needed to reset your mindset. Emotional regulation prevents impulsive actions and keeps you aligned with your strategy. Point 6. Post-trading reflection. End each trading session with reflection. Review your journal entries. Analyze mistakes without judgment. Celebrate successes, no matter how small. Adjust your plan based on insights. This habit reinforces learning and emotional resilience. Point 7. Continuous education. Markets evolve. The trader who stops learning risks falling behind. Make it a habit to read trading books or articles, watch educational videos or webinars, analyze new strategies cautiously in demo accounts, engage with trading communities for fresh perspectives. Lifelong learning sharpens your edge and builds confidence. Building these habits. Practical tips. Start small. Don't overwhelm yourself. Introduce one habit at a time and master it. Use reminders, set alarms, or use apps to prompt habit execution. Accountability. Partner with a mentor or trading buddy to stay motivated. Track progress. Use checklists or habit trackers to monitor consistency. Be patient. Habits take time to form, typically 21 to 66 days of repetition. The compounding effect of habits individually. These habits may seem minor, but combined, they create a powerful mental framework that enhances decision-making, reduces emotional volatility, builds trust in your process, increases your ability to adapt to changing markets over months and years. This compounding effect transforms your trading mindset and performance. Final thoughts. Habits are your trading edge. While many traders chase new indicators or secret systems, the real edge lies in your daily habits. These consistent behaviors shape your mindset, your discipline, and ultimately, your results. Commit to cultivating habits that support your trading goals. Invest in your process daily. Your future self and your trading account will thank you. Chapter 12. Rewiring the brain for growth. Harnessing neuroplasticity to develop a resilient and adaptive trading mindset. The human brain is a remarkably adaptable organ. Thanks to neuroplasticity, the brain's ability to reorganize itself by forming new neural connections throughout life. You are not stuck with the mindset or habits you have today. You can rewire your brain to think differently, manage emotions better, and approach trading challenges with resilience and clarity. In this chapter, we'll explore how to consciously harness this power to build a mindset that supports growth, learning, and long-term success in trading. Understanding neuroplasticity and its role in trading mindset. Neuroplasticity means your brain can change physically and functionally in response to your experiences and habits. This capacity allows you to replace old, unhelpful thought patterns with new ones, reduce impulsive emotional reactions, strengthen focus, patience, and discipline, build confidence grounded in actual skill and experience. Trading success depends as much on mental conditioning as on technical skill. If you can train your brain to respond calmly to losses, to see mistakes as learning opportunities, and to stick with your process, you will dramatically improve your results. Common limiting neural patterns in traders. Before rewiring, it's important to recognize the neural patterns that often sabotage traders. Fear-based reactivity. The brain's threat system kicks in at losses, triggering fight, flight, or freeze responses. Greed-driven impulsivity. Reward-seeking circuits push for quick gains, leading to chasing losses or overtrading. Fixed mindset. Belief that ability is innate and unchangeable, causing avoidance of challenges and fear of failure. Confirmation bias. Seeking information that supports existing beliefs and ignoring contradictory data. Emotional overattachment, linking self-worth to trading outcomes, increasing stress and poor decisions. Rewiring helps replace these patterns with adaptive responses aligned with your goals. Practical steps to rewire your brain for trading growth. 1. Mindfulness meditation. Regular mindfulness practice trains your brain to observe thoughts and emotions without immediate reaction. It strengthens the prefrontal cortex, the area responsible for executive control and emotional regulation. Start with 5 to 10 minutes daily. Focus on your breath or bodily sensations. When your mind wanders, gently bring it back. Over time, this practice builds mental resilience and reduces impulsivity. Point 2. Cognitive behavioral techniques. Challenge and reframe negative or limiting beliefs. Identify thoughts like, "I'm a bad trader," or "I must win every trade." Replace them with balanced statements such as, "Losses are part of learning," or "I can improve with practice." Journaling helps track these thoughts and progress. Point 3. Visualization and mental rehearsal. Visualize yourself executing your trading plan calmly and confidently, handling losses with grace and patience. This mental rehearsal builds new neural pathways, preparing your brain for real-world performance. Practice visualization daily, especially before trading sessions. Imagine specific scenarios, such as sticking to stops or avoiding revenge trades. Point 4. Deliberate practice with feedback. Engage in focused practice sessions where you consciously apply new habits or strategies. Use feedback loops like journaling and coaching to reinforce learning, breaking down complex skills into small components. Practicing consistently and mindfully, adjusting based on outcomes. Point 5. Positive affirmations and self-talk. Regularly affirm your strengths and commitment to growth. Positive self-talk can counteract stress hormones and build confidence. Create personal affirmations that resonate with your goals. Repeat them daily, especially during stressful periods. Neuroplasticity requires consistency and patience. Rewiring your brain doesn't happen overnight. It requires consistent effort over weeks and months. The more often you practice new behaviors and thoughts, the stronger the neural pathways become, eventually overriding old patterns. Think of it like carving a new path in a forest. The first few walks are difficult, but with repetition, the path becomes clear and easy to follow. Avoiding common pitfalls. Expecting quick fixes. Change takes time. Impatience can cause frustration and abandonment. Inconsistency. Skipping practice weakens progress. Ignoring emotional cues. Suppressing feelings rather than acknowledging them slows growth. Overloading. Trying to change too many habits at once leads to overwhelm. Start small, focus on 1 or 2 techniques, and build gradually. The long-term impact of rewiring. As you rewire your brain for growth, you will notice greater emotional stability during trades, improved ability to handle losses without despair, reduced impulsivity, and improved discipline, stronger confidence rooted in skills, not luck, a mindset open to continuous learning and adaptation. This mental transformation not only improves your trading, but enriches your life beyond the markets. Final thoughts. Your brain is your greatest trading asset. At the core of every trade is a decision made by your brain. By investing in rewiring it for growth, you invest in your most valuable asset, yourself. No indicator or system can replace the power of a resilient, focused, and disciplined mind. Harness neuroplasticity through intentional practice and watch how your trading and your life transforms. Chapter 13. Stop scrolling. Start studying. Breaking digital distractions to focus on continuous learning and growth. In today's digital age, we are more connected and more distracted than ever before. Smartphones, social media, endless notifications, and streaming services provide constant streams of information and entertainment, all designed to keep our attention locked in. For traders, this digital overload is a major threat. It sabotages focus, fuels impulsivity, and steals precious time that could be invested in learning and skill development. This chapter is a wake-up call. To succeed in trading, you must stop scrolling mindlessly and start studying intentionally. We'll explore why cutting digital distractions is critical, how it impacts your trading mindset, and practical steps to reclaim your attention for growth. The distraction epidemic and its impact on traders. Scrolling through social media or news feeds activates dopamine release, the brain's reward chemical, creating a cycle of craving and temporary satisfaction. This cycle trains your brain to seek quick bursts of entertainment rather than deep focus. For traders, this leads to reduced attention span, making it harder to analyze charts or develop strategies thoroughly. Increased impulsivity, jumping into trades without proper setup or planning. Emotional volatility, reacting emotionally to market noise and external stimuli. Procrastination, delaying study, journaling, and review in favor of passive consumption. Trading requires sustained concentration, patience, and deliberate practice, none of which thrive in a distracted mind. The opportunity cost of mindless scrolling. Every minute spent scrolling is a minute lost from reading quality trading books or articles, watching educational videos and webinars, practicing with demo accounts or paper trading, reviewing past trades and journaling, reflecting on emotions and behaviors over weeks and months. These lost minutes add up to missed opportunities for growth. Instead of compounding your skills, your trading stagnates or declines. How to shift from scrolling to studying. Transitioning from passive scrolling to active studying requires both mindset shifts and practical habits. Point 1. Set clear learning goals. Define what you want to achieve with your study time. Examples: understand candlestick patterns in depth. Improve my risk management strategy. Learn to interpret economic indicators. Clear goals focus your attention and give purpose to your study sessions. Point 2. Schedule dedicated study time. Treat study like a non-negotiable appointment. Block specific times daily or weekly for focused learning. Use a timer or the Pomodoro technique, e.g., 25 minutes study, 5 minutes break. Avoid multitasking during study sessions. Point 3. Create a distraction-free environment before studying. Silence notifications or turn on do not disturb mode. Use apps or browser extensions that block distracting sites. Choose a quiet, comfortable space with minimal interruptions. Point 4. Curate quality learning resources. Avoid information overload by selecting trusted books, courses, and mentors. Focus on depth rather than breadth. Pick one topic to study thoroughly before moving on. Balance theory with practical application. Point 5. Engage actively with material. Passive reading or watching is less effective. Enhance retention by taking notes, summarizing key points in your own words, teaching concepts to others, applying ideas in simulated or small real trades. Point 6. Limit social media use. Set boundaries for social media. For example, check platforms only once or twice a day. Use social media intentionally, networking, market news, not mindlessly. Replace scrolling time with a quick review of trading journals or articles. Benefits of prioritizing study over scrolling. When you commit to studying, you will notice improved understanding of markets and strategies, increased confidence in your decisions, reduced emotional reactivity as knowledge replaces uncertainty, stronger discipline and patience, faster progress toward your trading goals. Overcoming resistance and building momentum. It's natural to feel resistance when breaking scrolling habits. They are designed to be addictive. To overcome this, start with small steps, e.g., 5 minutes study instead of 30. Reward yourself after study sessions. Track your progress visually, journals, checklists. Remind yourself of your long-term vision regularly. Seek accountability from mentors or peers. Final thoughts. Your attention is your most valuable asset. Your attention is the currency of success. The markets will always be there, but your ability to learn, focus, and grow depends on how you manage your time and mental energy. By choosing to stop scrolling and start studying, you reclaim control over your mind. You invest in your greatest asset, yourself. Chapter 14. The trader's inner game. Mastering your inner world to excel in the markets. Trading is often portrayed as a battle against the markets, filled with technical charts, patterns, and economic data. But the true battlefield lies within your mind, emotions, beliefs, and habits. This is what we call the trader's inner game. In this chapter, we dive deep into mastering your inner world, because your psychological state shapes every decision you make. By strengthening your inner game, you gain control over fear, greed, doubt, and overconfidence, enabling consistent and disciplined trading. What is the inner game? The inner game refers to the mental and emotional processes that govern how you think, feel, and behave in trading. It includes your beliefs about yourself and the market's your emotional reactions to gains and losses, your mindset around risk and reward, your level of self-discipline and patience, your ability to stay focused under pressure. Trading challenges your inner game constantly, and without mastery, even the best strategies can fail. Why the inner game matters more than tools and techniques. Many traders focus excessively on learning indicators, chart patterns, or algorithms. But without a strong inner game, technical knowledge alone is insufficient. Emotional reactivity can lead to overtrading, revenge trading, ignoring stop losses, hesitation at critical moments, inconsistent adherence to plans. The inner game is the foundation upon which technical skills build. It governs whether you can execute your edge or not. Key components of the trader's inner game. 1. Self-awareness. The ability to observe your thoughts and feelings objectively is critical. Recognize when emotions like fear or greed arise. Notice mental patterns such as catastrophizing or impulsivity. Use journaling and reflection to increase awareness. Self-awareness gives you the space to choose your response rather than react automatically. Point 2. Emotional regulation. Trading emotions run high due to uncertainty and risk. Learn techniques like deep breathing, mindfulness, and grounding to calm intense feelings. Develop patience to wait for setups instead of rushing. Avoid chasing losses or doubling down out of frustration. Emotional regulation keeps your decisions rational and consistent. Point 3. Mindset of growth and resilience. Adopt the belief that losses and mistakes are learning opportunities. Embrace a growth mindset where skills improve with effort. Cultivate resilience to bounce back from setbacks. Avoid blaming external factors. Focus on what you can control. This mindset keeps you progressing and prevents discouragement. Point 4. Confidence balanced with humility. Confidence empowers decisive action, while humility keeps you open to learning and cautious about overestimating your abilities. Trust your analysis, but be ready to adapt. Avoid arrogance that blinds you to risks. Maintain realistic expectations. Balanced confidence sustains long-term success. Point 5. Focus and discipline. Your inner game is tested by distractions and impulses. Build habits that support focus, such as routine, journal review, and limiting multitasking. Use discipline to follow your plan, including risk management rules. Practice delayed gratification, waiting for high-probability setups rather than impulsive trades. These qualities ensure your strategy translates into consistent execution. Techniques to strengthen your inner game. Mindfulness meditation builds mental clarity and reduces emotional reactivity. Visualization, mentally rehearsing trades, boosts confidence and prepares you for challenges. Journaling tracks progress, emotions, and insights, promoting self-awareness. Affirmations, positive self-talk reinforces belief in your process. Breathing exercises calm your nervous system during stressful moments. Overcoming common inner game challenges. Fear of loss. Accept losses as part of trading. Manage risk to reduce impact. Greed and overtrading. Set strict rules and reminders of long-term goals. Impatience. Practice patience techniques. Remind yourself the market will provide opportunities. Self-doubt. Build confidence through preparation and small, consistent wins. Overconfidence. Maintain humility and regularly review your performance objectively. The inner game is continuous mastery of the inner game is not a one-time achievement, but an ongoing process. Markets evolve, and so do you. Stay committed to self-reflection, learning, and adapting your mental approach. Final thoughts. Win the inner game to win in the markets. Your greatest competitor is not the market, nor other traders. It's the voice inside your head. By mastering your inner game, you equip yourself with the greatest advantage in trading: control over your mind and emotions. Develop this strength, and no matter what the markets throw at you, you will remain steady, disciplined, and prepared to seize opportunities. Chapter 15. Growth is the goal. Embracing continuous improvement as the path to trading success. As we reach this concluding chapter, it's important to reflect on the core theme that underpins everything you've learned so far. Growth is the true goal of trading, not just profits. While financial gains are the natural outcome of skillful trading, they should never be the sole focus. Instead, committing to personal and professional growth will lead you to sustainable success, both in the markets and in life. In this chapter, we explore why growth must be your primary objective, how to cultivate a growth mindset for trading, and ways to keep evolving as a trader long after you've achieved your initial goals. Why growth trumps profits. Many traders enter the market with visions of quick wealth. This focus on profits alone often leads to risky behavior driven by greed or desperation, emotional burnout from the roller coaster of wins and losses, frustration when results don't match expectations, giving up after setbacks. By contrast, focusing on growth shifts your attention to building skills, knowledge, and discipline, developing emotional resilience, learning from every trade, win or lose, embracing challenges as opportunities. This approach creates a solid foundation, where profits naturally follow consistent improvement. The growth mindset in trading, coined by psychologist Carol Dweck. The growth mindset is the belief that abilities can be developed through dedication and effort. Traders with this mindset see setbacks as temporary and fixable, embrace learning and feedback, persist despite difficulties, celebrate progress, not just outcomes. Adopting a growth mindset helps you maintain motivation and adapt to changing markets, making you more resilient and effective. Practical ways to make growth your goal. 1. Set process-oriented goals. Focus on goals you can control, such as sticking to your trading plan, improving risk management, journaling daily, increasing patience and discipline. These process goals build competence and confidence. Point 2. Reflect and learn constantly. Make reflection a habit. Review trades regularly. Analyze what worked and what didn't. Identify emotional triggers. Adjust strategies based on insights. This keeps you aligned with your growth path. Point 3. Celebrate small wins. Recognize incremental improvements. Whether it's better trade execution or improved emotional control, celebrating progress reinforces positive habits. Point 4. Stay curious and keep learning. Markets evolve. Stay engaged by reading books and articles, participating in courses and webinars, networking with other traders, testing new ideas in demo environments. Lifelong learning fuels growth. Point 5. Practice patience. Growth takes time. Avoid rushing results or comparing yourself to others. Trust the process and focus on steady progress. The ripple effect of growth as a goal impacts more than just trading. It fosters qualities like discipline and focus applicable to all areas of life. Emotional intelligence that improves relationships. Problem-solving skills transferable to new challenges. Confidence that extends beyond the markets. In essence, trading becomes a tool for overall personal development, staying committed through plateaus and setbacks. Growth isn't always linear. Expect periods of stagnation or difficulty. During these times, remind yourself of the bigger picture. Revisit your goals and motivations. Adjust strategies without abandoning the process. Lean on your support system of mentors or peers. Perseverance during tough phases differentiates successful traders from those who quit. Final thought. Trading as a journey, not a destination. Viewing trading as an ongoing journey of growth shifts your perspective from fleeting results to lasting fulfillment. Every trade, every lesson, every challenge is a step toward mastery. When growth is your true goal, profits are not just numbers. They are signs of your evolving skill, patience, and wisdom. Keep growing, keep learning, and success will follow. Closing chapter. From gambler to growth-minded trader, transforming your trading journey for lasting success. As we bring this book to a close, it's time to reflect on the profound transformation that distinguishes a gambler from a growth-minded trader. This transformation is not merely about changing tactics or strategies. It's about evolving your mindset, your habits, and your relationship with the markets. It is the shift from chasing quick wins fueled by chance and emotion to committing to steady, disciplined growth fueled by skill and resilience. This closing chapter is a celebration of that journey and a guide to carrying your newfound mindset forward for lasting success. Understanding the gambler's mentality. At the outset, many traders enter the market with a gambler's mentality, seeking rapid gains, driven by excitement and hope rather than strategy. This mindset is characterized by risking more than is prudent, betting big on sure things, or chasing losses. Emotional decision-making, reacting impulsively to wins and losses. Ignoring process and discipline, focusing solely on the outcome. Short-term focus, hoping for instant wealth without preparation or patience. While thrilling, this approach is unstable and often leads to significant losses and burnout. The shift to a growth-minded trader. Becoming a growth-minded trader means adopting a fundamentally different outlook. Focus on learning and improvement, valuing each trade as a chance to develop skills, prioritizing process over profits, following rules and plans consistently, managing risk with respect, protecting capital to stay in the game long term, practicing emotional discipline, responding thoughtfully, not reactively, embracing patience and persistence, understanding that mastery takes time. This mindset turns trading from a gamble into a professional pursuit. Key markers of your transformation. Reflect on how far you've come by considering these markers. You've replaced impulsive, emotionally driven trades with well-planned, thoughtful decisions. You respect risk management as a form of self-care rather than an obstacle. You use losses as valuable feedback rather than reasons to quit. You engage in regular reflection and learning through journaling and study. You accept that success is a gradual process, not an overnight event. Each marker reflects deeper self-awareness and maturity as a trader. Maintaining your growth mindset in practice. The markets will test your mindset continually. To sustain your growth orientation, stick to your routines and habits. These keep you grounded when emotions run high. Seek community and mentorship. Sharing experiences and learning from others accelerates growth. Celebrate progress, not just profits. Recognize improvements in discipline, strategy, and emotional control. Be adaptable. Stay open to new ideas and changes in market conditions. Practice self-compassion. Trading is challenging. Treat yourself kindly through setbacks. Your trading journey ahead. Trading is not a destination, but an ongoing journey. The skills and mindset you've developed form a strong foundation, but continuous growth and adaptation are essential. Remember, markets evolve, and so must you. Every challenge is an opportunity for growth. The discipline and resilience you cultivate here will serve you beyond trading. Final encouragement from gambler to growth-minded trader. You have taken the most important step towards sustainable success. This transformation empowers you to approach trading with confidence, clarity, and control. Carry this mindset with you every day. Let it guide your decisions, temper your emotions, and fuel your commitment to excellence. The market is a demanding teacher, but with a growth mindset, you are well-equipped to learn its lessons and thrive. Bonus section for audiobook listeners. Maximizing your learning and application through active listening. Thank you for reaching this bonus section, specially crafted for audiobook listeners like you. Listening to a book provides a unique opportunity to absorb knowledge in a flexible, convenient way, whether you're commuting, exercising, or relaxing. However, to truly transform your trading mindset and skills, active engagement is essential. This bonus section offers practical tips and strategies to help you maximize your audiobook experience and turn listening into meaningful action. Why active listening matters. Audiobooks can be easily consumed passively, where the content flows through your ears without deeper processing or follow-up. Passive listening limits retention and application, especially for complex topics like trading mindset and psychology. Active listening means paying close attention to key ideas, reflecting on how concepts relate to your personal experience, taking notes or marking important points, planning how to implement lessons in your trading routine. Active engagement helps move information from short-term memory into long-term understanding and habit formation. Tips for effective audiobook learning. 1. Choose the right environment. Find a quiet or semi-quiet setting where you can focus. Minimize distractions like notifications, background noise, or multitasking. Use good quality headphones to improve audio clarity. 2. Pause and reflect regularly. Don't hesitate to pause after important sections. Take a moment to consider how the concepts apply to your trading. Ask yourself questions. How does this relate to my current mindset? What habits can I change based on this? What challenges might I face implementing this? 3. Take notes. Use a notebook, note-taking app, or voice recorder to jot down key points. Summarize ideas in your own words to enhance understanding. Write down any questions or insights that arise for later review. 4. Create actionable steps. Identify 1 to 3 specific actions you can take immediately. For example, I will journal every trade starting tomorrow, or I will practice a 5-minute breathing exercise before trading. Scheduling these actions increases the chance you follow through point 5. Revisit and review replay challenging or impactful sections to reinforce learning. Combine audiobook listening with reading summaries or related materials. Periodically review your notes and progress. Using audiobooks to complement your trading journey. Audiobooks can become an essential tool in your ongoing growth plan. Daily reinforcement. Listen to chapters during routine activities to keep key ideas top of mind. Mindset boosts. Play motivational or mindset-focused segments before trading sessions. Continued education. Supplement technical learning with psychology and emotional discipline. Audiobooks. Community discussions. Share insights with trading peers or mentors to deepen understanding. Suggested practices for audiobook listeners. Integrate with journaling. After listening, add reflections or new insights to your trading journal. Set listening goals. Break the book into manageable chunks, e.g., 1 chapter per day. Use visualization. After hearing a technique, close your eyes and mentally rehearse applying it. Apply immediately. Don't wait to finish the book. Before acting, implement small changes as you learn. Final words. Listening to this audiobook is a fantastic first step toward transforming your trading mindset. Remember, knowledge alone won't change your results. Consistent application will. By actively engaging with the content, reflecting deeply, and taking deliberate action, you turn listening into lasting growth. Thank you for trusting this journey. May your trading path be one of steady growth, discipline, and success.